Praveen Jaipuriar, who's the CEO of CCL Products, is something that a lot of people know but get confused every time and ask every time. Mr. Jaipuriar, thanks so much for joining in. Here's my question to you. For a longest time, right, Srishant, etc., have said that coffee prices moving up or down don't have a material impact on your business because it's a pass-through. Then people add a layer of, oh, but there could be inventory losses, there could be inventory gains, some this thing, etc., etc. Can you explain this to us? If Arabica coffee prices go up 10%, does it have a material impact on your business? Margins, inventory, what have you?
So, okay, I'll take it up, module by module. So first and foremost, yes, coffee prices increasing will have a top line impact because we pass through. What will happen is that my top line will start looking much higher than my volume growth. Yeah. So that is one impact. But because we pass through all the cost, and my model is cost plus model, which means that if any client was to ask me a coffee rate today, what I would do is I would take today's coffee bean rate and build my conversions and yields and my margins and then quote the rate, which means that whatever the coffee prices is, all my costs and margins are loaded on top of it, and that's how I quote to the client. And if the client was to confirm the contract, I would end up buying the coffee as well today. So it also doesn't have any impact on my inventory. There is no hedging that we do, which makes us, insulated from any with the coffee prices. And it's also beneficial for the clients because they also are very sure that this is the contract they've got, and there is no increases or decreases that would happen because sometimes they enter into long-termish contract. Yeah. So 6 months down the line, they are assured that the prices that they had contracted with us remain stable. So which means that, my EBITDA per kilo, and that's the matrix we kind of, share with you guys, is that my EBITDA per kilo kind of doesn't change. On a let's say EBITDA level, my EBITDA growth will actually mirror my volume growth. Yeah. So that's the best way to look at our business, because that's how our model has been built on.
So are you saying that your EBITDA per kg guidance of 110 rupees stays the same? Because I know you are, you have long-term contracts to hedge against this kind of volatility. I'm just wondering, Mr. Praveen and Tamanna here, good morning, whether over time this intense volatility in prices also continue to have no impact, because it's been going on for a while. And it is unusually volatile. You have seen an unusual spike in coffee prices. So yes, you have all the safety nets in place. Is it sufficient, and are you sticking to 110 per kg?
Yeah, absolutely. So my per kilo EBITDA doesn't change at all, So, high coffee prices doesn't impact my margins, and therefore, and when I say margins, don't confuse it with percentage margins, because what happens is that when coffee prices are on a high, because of my cost plus model, my revenue goes up higher. So as a percentage, optically it may look lower, but on a per kilo EBITDA basis, it doesn't change. What high coffee prices does is something else, probably, any commodity price increase, one would be the worrying factor, or the worrying matrix that one could look at, is that whether there is an impact in consumption or not. And thankfully, as of now, till now, we haven't seen any kind of an impact in the consumption levels. And as far as the consumption is concerned, if that is intact, we are in business, yeah, because people are drinking coffee, and therefore there will be volumes that will keep coming.
Are you saying demand is completely inelastic? I know from your point of view, you're hedged, so demand is completely inelastic. That's what you've been seeing. And 110 per kg for the next 2 years is something that you're sticking to. I'm reiterating that question.
Absolutely. We're sticking to 110 rupees per kilo. And we're also seeing no no consumption pattern changes. People are drinking coffee. Probably it's a scheduled drink. You drink your morning cup and evening cup regularly. Even if the prices are going up, I'm seeing that there is not much of a impact that has happened. And that's one of the reasons why coffee prices have gone to the levels that they are. Had the demand not been there, I don't think so it would have reached the levels that they are today. Yeah. So that's an indication, because if the supplies were constrained And the prices have gone up 3 times in the last 3 to 4 years. And still there is, demand for coffee, and there is, supply constraints, and the prices have gone up. So on one side, it's a good indicator that people are still drinking coffee.
Coffee is the new oil. Is that so? But Mr. Jaipuria, I just want to reiterate, just for my understanding, and excuse me for not understanding it clearly. I hear you that the per kilo margins may not get impacted, but I'm just trying to think about it from a reported numbers perspective. If there is a 10% increase in coffee prices, do your reported EBITDA margins, I understand your revenue goes up, let's say by 10%, volumes remaining constant. Do your
Right.
reported EBITDA margins get impacted in any fashion whatsoever? Averaging out for 3-4 quarters, one quarter may be here and there, but averaged out,
Yeah.
let's assume prices are higher by 10% for 4 quarters. What happens to reported margins?
So my reported, so let's say if I sell 100 kilos and my prices go up by 10%, and let's say 100 kilos remains constant.
Yes.
So on each kilo, I'll still earn 110 rupees. So my EBITDA will be 100 into 110, yeah?
But reported
But
margin might come down a bit.
reported margin may optically you may see that as a percentage of top line, because we don't share volume numbers, or as a percentage of time it may look like it's coming down, but it's actually not coming down because we are growing. The EBITDA margin is exactly growing as in line with volume growth. So that's what we try, and that's the guidance we have given. And that's the reason we talk about volumes. When we gave guidance of 10 to 20%, we said that in that pace, the EBITDA margins, EBITDA will also grow. Yeah.
Mr. Jaipuria, you work in a very interesting model and we're all very fascinated by it. We've tried to understand what the impact of the movement in coffee prices is on your business. But from what I also understand, and please try and break this down for me, post-December, as you shift to long-term contracts, what will the impact be of this on revenue predictability and cash flows? What I want to understand, and if you can quantify this, what proportion of contracts are likely to transition to long-term, and how much of that will remain unhedged? Because if it is unhedged, I would imagine there would be an impact, and if it's hedged as well, there would be an impact. Just, break this down for me.
Okay, so let me first clear the context. See, it's just not in my hands to move into long-term contracts. It's largely in client's hand. And what happens is that when the coffee prices are rising the way it has been for the last 2, 3 years, generally the clients get into a wait and watch mode, because every time there is an increase, everyone's belief in the industry, whether it is traders, manufacturers, brand owners, everybody has believed that it is going to come down, it is going to soften. So people are in a wait and watch mode, saying that let us not, because if we are cost plus and we would do the contract at current prices, they don't want to get locked at high prices and then see the prices coming down. So everybody is on a wait and watch. They give shorter term contracts. The reason why we are saying that we are trying to do more long term contracts, because we are trying to convince our clients that in the near future we don't see the coffee prices softening a lot, because these supply constraints are there. The demand is not letting there's no decrease in the demand, which means that in the short term I don't see much of an impact or much of a softening of prices. And therefore we are urging clients to enter into long term contracts, because what it does is that it gives a lot of stability to them in terms of prices. Now, breaking down to hedging, non-hedging, as I told earlier, that any contract that we enter into, if it's a confirmed contract, we end up buying coffee then and there. So which means that there is nothing that is left to any volatility in the future. Everything is confirmed, bought, and taken into our books and inventories. So that's how it goes. Long-term contracts are only beneficial from both sides. For us, there is no change in margin structure and all that, but it makes our supply chain management, our capacity planning management, all that becomes easier for us.
Mr. Jaipuria, you've added, looking to add distribution to 150,000 outlets. How much of this growth is factored into your FY24 guidance, and how much incremental will it add to the next financial year? And I do understand by increasing volume growth, your debt levels are going to rise. So also walk me through where your debt equity ratio will be at the end of financial year 25 and what happens next year.
Okay, so let me cover the debt part first, and then I'll come to the distribution part because that's about B2C. So as far as debt is concerned, yes, today we are on high levels of debt because for the same volumes I have to, incur more cost in buying the coffee. So therefore, the debt levels are at high levels. It looks like the end of the year at a group level, our debt equity will be closer to 1.1, 1.2. But just as we were talking about, our model, the good part about our model is that all that working capital debt is for confirmed contracts. So we don't buy coffee for inventory. We are not speculating in buying coffee. So whenever we are buying coffee, only if the contract is done. So all that working capital is for confirmed contract. So that's something that we don't overtly get worried on. So that's on the debt and the debt equity part. Now, coming on to the distribution, this is about our B2C business. You all know we started our B2C venture, our own brands, 5, 6 years ago, and that has yielded reasonable results. We are doing extremely well in the market. Now, the number 3 brand of coffee in India, and that's where we are trying to improve our distribution. Currently, we are at 1,20,000, 1,30,000 outlets. We are wanting to end the year at around 1,50,000 outlets, and this will all reap dividends because the more distribution muscle I add, the more sales and offtakes that I'll generate for my own brand, and these are all factored into our growth projections for this year and next year as well.
Okay, so just last point, Mr. Jaipuriar, your volume growth was about 10% in Q2. You expect that to continue? I know you've spoken about every other metric, but you see the volume growth as well on the same track or an improvement?
Yeah, we are pretty much on track, and especially when as we have always maintained, not just quarter by quarter, in a slightly longish term. So we are looking to end the year at that kind of a volume growth, which means that even the EBITDA growth and the first half, the EBITDA growths have been better than the volume growth. So we kind of will maintain with that momentum as of now. And let's see how the future entails in terms of the green coffee prices and which way the wind blows.
Which way the wind blows? Well, whichever way it blows, people are not giving up on their cup of coffee. I think that's the big takeaway from this conversation.
I can tell you, Mr. Jaipuriar, the two women to my right in the studio are not giving up on coffee. They have it every day. So you are in safe zone.
I'm trying to cut down because it's too much. But anyway, thank you so much. Thank you so much, Mr. Praveen Jaipuriar, for speaking with us.